And it creates these bubbles here and a bubble there. And lately it's been a bubble everywhere. This is a unique situation. Well, this is obviously a very complex question because, as you know, an economy consists of different sectors. And in the global economy, we have different countries at different stages of economic development. And then we had this huge financial bubble in the world called the financial system. And some markets are very high. Statistically seen, the US is very highly valued at the present time, in particular the popular stocks, the FANG stocks, the Magnificent Seven and so forth. And we have other markets that are relatively depressed. And some markets are actually also in absolute terms depressed. And I'm bringing this up because people, when you meet them at parties and at whatever events, they always say, yeah, I want to buy low and sell high. But actually, throughout financial history, people have done exactly the opposite. They buy high and sell low. I mean, this is a remarkable thing. I mean, I'm bringing this up because, as you know, at the present time, individuals and institutions in America have piled into US stocks. And the cash positions of both individuals and of financial institutions as a percentage of total assets is very low. It's at a record low. So the public and the financial institutions are euphoric about this market, especially after Trump got elected. But at the same time, you have, say, a proven investor that has done well over half a century, who is increasing his cash position. So you have the masses of people who buy things they have actually no clue about. They say, yes, NVIDIA is good, but exactly what NVIDIA does, they don't know. These are the same people that bought Cisco in 1999, 2000. And one man who essentially is a patient investor, is not a genius, he says himself, and Charlie Munger, who passed away recently, they both argued their strength is their patience and also long-term orientation, and that they don't have to deliver every quarter results. So this man, Warren Buffett, as a percentage of total assets, he's at a record high. It gives you something to think about. I mean, philosophically, the public buying like crazy, and one man who is a proven investor is maintaining a high cash position. And concerning the economy, all I can tell is that we had a setback. I'd call it actually an artificial setback brought about by COVID, but as we know now, and as some people knew right from the start, this COVID is an organized business deal, the purpose of which eludes me somewhat. But anyway, the economy collapsed, and from the collapsed low, say in May, June 2020, we had a recovery in the global economy, but most sectors of the global economy are still below the level in 2019, 2018. So we had a recovery, but it's not as strong as one would have expected it to be. And some countries are actually hardly recovering. And some sectors are actually way down from the peak level in 2019, partly because society has changed. So the global economy, in my view, is actually weak. Whether it will tilt into a serious recession or not, I wouldn't know. But one thing I know, we're dealing with a two-tiered economy. the money printing by the Fed has not helped the typical household, not at all. The typical household is faced, and this is not only in the US, it's in Europe the same, and in other countries the same, is faced with cost of living increases that exceed his wage gains. And as a result of that, over 70% of people in the US live paycheck to paycheck. Paycheck to paycheck means essentially you have to wait for your check at the end of the month to pay your bills. That is the definition of living paycheck to paycheck. In my view, it's a modern form of slavery, because the people who live on paychecks, they cannot express their own opinions. They have to do what they're told by the system or by the companies they work for and so on. And the rich people, they benefited from money printing. And this is the crazy thing about monetary inflation. It distorts everything. The prices are very difficult to determine. You can say this is expensive compared to that and so on, but it's very difficult to say this is absolutely expensive or absolutely cheap, because the monetary inflation touches different sectors of the economy at different times, and it creates these bubbles here and a bubble there, and lately it's been a bubble everywhere. This is a unique situation. The Fed, in my opinion, the central bank in America, they're probably right to cut interest rates. I'm not saying they're right absolutely, but probably right when they look at the labor market and when they look at the real economy of poor people, of the typical household in America. But if I gave someone the financial picture and said, Bitcoins is at an all-time high, gold is near a high, stocks are at an all-time high, and the inflation is such and such, and I look at the inflation from a different perspective as the Bureau of Labor Statistics. The ownership of gold is a necessity for anyone who wants to keep liquidity and its purchasing power, because paper money loses the purchasing power, but not gold. And my view is that as long as we have central banking in the world and some academics kind of telling you the inflation is 2% or so, when their wives, when they go shopping, they know that it's more than that. The BLS had healthcare costs down 30% over the last 3 years. I mean, it's a mind-boggling nonsense. But this is what the statistician published. And as Ira said, gold is actually reflecting precisely what is happening now in the world, in the sense that the liquidity is so huge that it drives up some crazy assets like cryptocurrencies. And I'm not saying that gold is a crazy asset, but if there was monetary stability, gold wouldn't be in a bull market. The gold price is telling you there is monetary instability, and that this instability will lead, like Ira suggested, to a recession at some point. Most people are already in recession, but the government can show that GDP is going up because the government is spending money through the deficits. And my view is that we are in a period of turmoil, and that the resource-oriented stocks, say you take oil stocks as the whole oil sector as a percent of the S&P, it's at a historical low or close to a historical low. whereas tech stocks are up here in the sky. And I've just seen, I mean, John Hussman, he's not the most bullish person, but statistically he's well informed, and he published statistics showing how the most expensive stocks and the most popular stocks perform in the long run. And in the long run, they don't perform better than the market. So it means that when they're grossly overpriced, like the case is now, they will underperform for a while. And I thought this is very interesting, that the public's money flows into most overvalued type of or expensive shares. And statistically, we can measure the PE, the price to sales, the price to book, and so forth. The US market is at the historic high valuation.
Here's the takeaway of Marc Faber's market perspective. Faber paints a complex picture of the current global financial landscape, highlighting a stark disconnect between market valuations and economic reality. He points to a particularly concerning trend in the U.S. markets, where both retail and institutional investors have pushed cash positions to record lows while piling into highly valued stocks, especially the Magnificent Seven. This behavior stands in sharp contrast to veteran investors like Warren Buffett, who has maintained record-high cash positions. The global economy, in Faber's view, remains fundamentally weak despite recovering from the COVID-19 setback. Most sectors still haven't returned to their 2018 to 2019 levels. He describes a troubling two-tiered economy where Federal Reserve money printing has widened the wealth gap. Over 70% of Americans live paycheck to paycheck, while wealthy individuals have benefited from asset inflation. This monetary policy has created what he calls a unique situation of bubbles everywhere. Most notably, Faber sees gold's bull market as a warning sign of monetary instability. He argues that in a stable monetary system, gold wouldn't be rallying. He's particularly critical of official inflation statistics, suggesting they significantly understate real cost increases. Looking at market sectors, he notes that while technology stocks are up in the sky, traditionally stable sectors like oil are at historic lows relative to the S&P 500. Historical data suggests that such extremely overvalued popular stocks typically underperform over the long run. In essence, Faber describes a market driven by euphoria rather than fundamentals, with warning signs that echo past bubble periods while presenting unique characteristics of its own.